This is your LMAX Exchange technical update for Thursday, March 23rd, 2017. Euro dollar. So we're now at that critical inflection point in the euro where the market's either going to break out to the top side or will look to resume a broader downtrend in favor of declines. We're at 108.75, which is that key resistance from December 2016. A break above that level will do a good job of confirming an inverse head and shoulders formation on the daily chart, exposing a move all the way up towards the 114 to 115 area. At the same time, if the market over the coming sessions is unable to establish above 108.75 and stalls out after just breaking above 108, we could see that resumption of declines. Initial short-term support to look at over the coming session comes in around 107.06. That's the low that we saw back on the 16th of March. A break below there would put the pressure back on the downside, or at least take the immediate pressure off the top side. Ultimately, though, we would need to see a break all the way back down below that recent low, just under 105, to really put the pressure on the downside and expose a retest of that 2017 low from January at 103.40, below which guards against that critical parity level further down. Sterling dollar. So cable has pushed back up over the past several sessions, coming up as high as above 125, but also into this critical resistance zone that you can see here. We've seen a lot of resistance into the 125 area, with the market well capped on rallies and overall still confined to a very significant downtrend, especially while it holds below that December peak at 27.75. That was the December 2016 peak. And so although we have seen this rally, the market is expected to once again stall out. That's where the risk is tilted, somewhere ahead of 126 ideally, in favor of that next lower top and fresh downside extension back towards the 1987-2017 low that was seen in January. Initial support for cable over the coming sessions comes in right around the 123.25 area, which is the low from the 17th of March. A break back below there will take the immediate pressure off the top side and again suggest that the market is looking for a resumption of declines. If we see a push back above 126, it could suggest that the market wants to trade higher and threaten a retest of that critical December 2016 peak. But again, the risks right now are tilted to the downside, with the market expected to stall out somewhere in this 125 to 126 area. Dollar yen. So a significant breakdown in dollar yen this week, with the market taking out some critical multi-day range support at 111.60. The break below 111.60 is significant, as it potentially opens the door for a 400-point move to the downside towards a measured move objective at 107.60. This is after we had seen a multi-day consolidation of 400 points between 111.60 and 115.60. So again, the break below 111.60 does open the door for the possibility of a move down towards 107.60 over the coming days. At this point, initial resistance here comes in by the recent high that we saw around 12.87, the high that we saw back on the 21st of March, and so a break back above that level would be required to take the immediate pressure off the downside. Euro Swiss. Euro Swiss continues to be confined to a broader downtrend, with the market very well capped into rallies, but also stubbornly supported on dips down towards 106. We have that 2016 low at 106.24, which if broken would open the door for an acceleration of declines towards next key psychological barriers at 105. But for now, the market is holding around 107, though overall, again, the pressure does remain on the downside, and it does appear that there's risk for a breakdown below the 2016 low at 106.24. Aussie dollar. So Aussie is showing signs of stalling out yet again, as the market has traded up towards 78 but can't establish above that critical level. Over the past several months, the market has stalled out ahead of 78, around 78, and so we're seeing another topside failure here, up after the market stalled out earlier at 77.50. Right now, key support here comes in by that low that we saw back on the 9th of March, down here 74.92. A break below that level will do a good job of accelerating declines and confirming another top in this market ahead of fresh downside that could take us all the way back down towards the 70 area. Of course, if we see a push back above this recent 2017 high at 77.50, that will take us to another test towards 78, but ultimately the market would really need to establish above 78 to convince of a more significant structural shift. Dollar CAD. So dollar CAD has mostly been consolidating over the past several sessions, though overall the outlook here is quite constructive as the market has been very well supported on dips and is confined to a broader uptrend. Any setbacks that we do see over the coming sessions should be very well supported ahead of 132 ideally, in favor of a higher low and fresh upside extension back above the recent highs and through the multi-day peak at 136 and towards 140 further up. Kiwi dollar. So Kiwi has seen a little bit of a recovery over the past several days, but overall this is a currency that has been underperforming, the New Zealand dollar that is, and so overall there should be risk for a lower top at some point over the coming sessions in favor of that next major downside extension below key medium-term support going back to December of 2016 around 68.62, below which it would expose the 65 area further down. SPX 500. The S&P 500 this week has finally shown signs of the onset of at least a short-term correction, with the market taking out some key support at 2350. This latest breakdown opens the door for fresh downside over the coming sessions towards that key psychological barrier at 2300. We actually have some previous resistance now turned support in the form of the high from the 26th of January around 2305, which is specifically that next key level, below which would open the door for a more significant decline. But again, right now, after this break below 2350, there is risk for a resumption of declines after a little bit of a consolidation down towards the 2300 area. Any rallies now should be very well capped, ideally ahead of 2375, with only a break and close back above the recent high that we saw on the 21st around 2382 to negate and then once again put the pressure on the top side for fresh record highs. Gold. So gold has been very constructive over the past several months, really since basing out ahead of 1100 in 2016, putting in a series of higher lows and higher highs. Most recently, we've seen a critical higher low in place at 1180, followed by a rally up towards 1265 and a pullback ahead of 1180 into the 1200 area, just below 1200. And so a fresh higher low is sought out right here around 1200 in favor of this next upside extension beyond 1265, which should take us towards a measured move of extension into the 1330 area. So again, ultimately here, the structure is very constructive with dips being very well supported and the market seen higher, eventually back towards a retest of the 2016 peak at 1375. Only back below 1180 would really compromise this out.